Welcome to another edition of Zacks Rank Buy. I am Brian Boland, and I am the aggressive growth stock strategist here at Zacks, and I've got two more stocks for your aggressive growth radar screen. So let's just jump right into it. Our first one is Jeld-Wen. Jeld-Wen, we can see the ticker is JELD. It's a Zacks rank number one. That's a strong buy. And this one has a B for growth and an A for value. Normally on our aggressive growth videos, we see an A for growth. I want to see that A right there. And then a lower value score. But this one came on my screen, and I thought, well, let's just take a look at it. The thing that intrigued me, just right from the chart here, we see a beat and a good-sized beat, and then the stock just careening straight down. What a tough summer this stock has seen. But let's, so this is a maker of doors, cabinets, exteriors for windows, that sort of thing. Obviously, the home building sector is into this as well as the commercial building space. So it's one of those names that doesn't want to see higher interest rates, yet we have seen very higher interest rates. And so the stock has really tailed off here. If we just look right here to our 52-week high and low, we're kind of smack dab in the middle there, but boy, again, that run down from 17, 18 down to $12, $13 right about now. All right, so let's take a look at the numbers that we normally look at. First, we jump to the detailed estimates page and we look at, can management communicate their strategy effectively to Wall Street? I.e., can they guide them below to a beatable range? And we can see 4 straight beats. They've all been very nice, very good size. This beat was really big, 300%. That's really skews the average there. So we'll call it in the 40 to 50% positive surprise range. But that's good to see. They're always beating. Where have the estimates gone? 38 cents to 36 cents. So not really an upward slide there for this quarter, but that could just be some shuffling of some pennies, but not really into this quarter because then again, we see 27 to 29. That is not always a good thing. But the full year, because of those big solid beats, we can see moving from $1.51 to $1.56. And next year, popping up from 164 to 69 and then down 2 more pennies. But on the 60-day window, that would be from here to here, we see that the increase is there and present. That gives us our Zacks rank number 2. Let's skip ahead. Now, why are you showing me a stock that's showing top line contraction, minus 16% this year and basically flat next year? It's amazing how sometimes things like that happen, and they will still get a strong growth style score. But a little bit of revenue contraction. Obviously, I think that a lot of that is interest rate driven. But obviously, we're going to have some good top line growth, or bottom line. We're going to have a little bit of bottom line contraction this year. Get it all back next year. All right. So is the stock dipped down low enough for us to warrant taking a very deeper dive in it? Well, 8 times forward earnings. That's a very low multiple. And we'd like to see that. 1.3 times booked, so small premium there. The Wall Street is not really rewarding this company for any dollar sales, giving it a price to sales multiple of 0.2 times. We'd want to see operating margins move up, not down. So we lost 10 basis points there in that quarter, and we got an NA there, so we don't really have a full clean view. Let's take a look at the chart, see what this stock has done. All right, here's the pandemic. The world's going to end. And then we shoot straight back up to highs in the $30 range up here on the back of a bunch of beats. Then we're looking at, some trouble, the housing market slowing down, that sort of thing, and missing a few quarters. But, it looks like we bottomed out there at 8, and then we're starting to really head higher here. Lots of beats. And we can see here the distance between the lines, the earnings projected lines, shows a move up. So with this particular move down, I would say that makes this a very interesting play, and that's why I want to keep it on my radar screen for aggressive growth, even though it doesn't Trey, all of the normal things we like to see, at least on price action, we would think that this is a interesting play. It's Jeld-Wen, Jeld, is the ticker. All right, next up is Palo Alto Networks, and that's PANW for your ticker. The Zacks rank number one strong buy. We've got a B for growth again, but an F for value, and that's more along the lines of what I want to see. I want to see a strong growth score and a weak value score to give me to make sure that I'm on the right path right away as an aggressive growth investor. All right, this is an internet software provider, but we know this is really more of a cybersecurity play. Obviously, there's been a lot of cybersecurity hacks very recently. MGM and the stuff going on in Vegas is primary to all of that. But there are numerous examples of other hacks very recently. So there is a lot of talk about the cyber warfare environment. I do want to point out this is not one of our smaller names. This is a very large $78 billion market cap name. So very, very, as we say, a big player, big company in the space. All right. Are they beating the number? Yes, they are beating the number. 4 straight beats. Not like Jeld-Wen here. They are reasonable beats for the most part, with a 22% average over the last year. Where are estimates going? Because that's what matters. We buy a stock for what it will do, not what it has. $1.10 up to $1.16 this quarter, $1.18 up to $1.26 next quarter. For the full year, $4.95 up to $5.34. We like that. And next year, $6.01 to $6.39. All good numbers on the estimates. All right, so let's take a look. What's happening? Are we growing? We are growing here, 18% this year and 18% next year on the top line. Add that with 20% bottom line growth this year and just about 20% next year. Boy, oh boy, I wonder what this PE is going to look like. It's going to be big. Yeah, it's 47 times. When you have good growth, good earnings growth, you're going to pay up for something like that. So your nifty 50 type stock, this is in a space that is necessary. It is important. So you're going to have a lot of people paying up, 26% versus year over year top line growth in the most recent quarter. All right, price to book, 44 times. Why is this number so gigantic? 44 times the assets. Well, it's cybersecurity, so it's software, it's code. There's not a lot of hard assets on the books, unlike Jeld-Wen, which would have number of plants and physical operations. So that's why you're going to have a big discrepancy. Price to sales, they're valuing their sales very richly here, 11 times. That's a lot. And look at how margins have just really started to move up here. You don't really see this often in a company this size, but coming in off the bottom, off lows, I don't know if that's the bottom. I'll just say it's pretty low, 2.65 to 5. That's basically a double right there. And then moving up another 250 some basis points. So big move in margins. Love to see that. Growth on the top line, growth in margins equals bigger growth in earnings. What has this stock done? Pandemic, the world's going to end. Oh no, $60 a share. That's where this thing was. And boy, oh boy, nonstop freight train, 45-degree angle, everything you live and die for as a growth investor. This is a name that is, obviously performing very well. Low risk to me, to be honest with you, even at the highs here. Let's take a look at this one thing. We'll chart the space between the lines here shortly after they've come out, right? And we can see those lines are getting bigger. There's more space between them. Love to see that. So that one, again, is Palo Alto Networks, PANW. Well, that's it for this week. Be sure to join us next week when we look at 2 more stocks for your aggressive growth radar screen. But until then, why don't you go to Zacks.com/promo to check out all of our latest promotions.